Welcome to today's webinar, Unlocking 2026 Will Lower Rates Reignite Commercial Real Estate? Moderated by John Winnick, Clark Street Capital, the expert in advising lenders on moving portfolios. John, you do a great webinar series. You have a panel of three great guests. Charles Krawitz, he's with Alliant Credit Union, Tim Mazzetti, Citus AMC, and Brad Salser, Lindell Capital. John, this is a great topic. I know I think I should stop talking and turn it over to the experts. But guys, welcome. John, take it away, man.
Yeah, well, let's dive right into it with the operative question. Have lower rates ignited commercial real estate? Let's take a comparison first to the residential market. You can see this chart. I think this is a great chart. So this is the 30-year fixed rate mortgage rate since 2000 and total U.S. home sales, both new and used houses. And you could see, go to 2020, 2021, you could see we got the mortgage rate down to 3%. There were almost 7 million homes sold. And as rates came down, home prices are basically very flat and at kind of near record low levels. So at least in the resi space, there's been modest to limited impact on lower rates with respect to residential home sales. Now, one of the factors that's different in residential versus commercial is this phenomenon of sub 3% mortgages. And, commercial loan is typically no more than 5 years. So it's a much shorter period to catch up to current interest rates, and you have the resi space. Another factor on the next slide is the consumer is seeing some stress. Now, the jump in student loans is, I wouldn't call it an anomaly, but during COVID, the government stopped collecting on student loans. So you see that spike of student loan delinquencies. You also see some elevated delinquencies in credit cards. So, the consumer is doing okay, but you're starting to see at least a segment of the consumer population that's feeling some stress. And as I go over to commercial real estate in the next slide, we're seeing some uptick in commercial real estate activity. This is the Lightbox CRE activity index, and there was a noticeable bump in December to January. February data isn't available yet. And what they do is they aggregate new property listings, appraisals, and environmental due diligence, because obviously those suggest activity. And I thought this was interesting. Average daily listings were up 81%. Obviously, there's seasonality there, but from December to January, and a whopping 38% from prior January. So, yes, you are seeing, I don't know if it's ignited, but you are seeing some evidence of increased activity in commercial real estate. As we go over to credit quality from our friends at TREP, the delinquency rate overall on CMBS loans is elevated. It didn't last month, but you could see in the past 12 months, over 100 basis point increase in delinquency across the board. And most notable, office and multifamily have seen, material spike in the past year. And the bottom is a headline from the Wall Street Journal: lenders to commercial real estate owners pay up now. So we are seeing, at least in our world, some less patience in dealing with credits that have been out there for a while. With that, I will pose the question to the group. The operative question: are you seeing any evidence that lower rates are reigniting CRE?
No doubt, green shoots.
Capital, while a lot of it is out there, is extremely selective. I think treading somewhat cautiously despite rates because of so many other factors that we're facing in the economy right now. And John, I do want to make a point. We were talking, and I'm a commercial real estate is my world, but as commercial real estate goes, so much goes, and we are seeing U.S. home builder confidence slipping based on affordability and high construction. And we fund builders and big lot development projects, and there's a lot of skittishness going on in what's going on in the resi. And the resi folks are the ones that fuel my commercial real estate assets with their rental income, is how I like to hope it goes. So despite perhaps lowering of rates, I'm seeing very cautious. I don't even know if the word is optimism, but I'm seeing a lot of caution out there. Will Rogers, caution.
John, I think the anticipation of lower rates causing a lot of capital sources to lend, to be available, to say, hey, if I don't lend now, I'm going to lend in a month or 2 months' time, and rates are going to be even lower. So I want to get my money out the door. So capital availability is certainly benefiting commercial real estate, and that in turn is causing a greater transactional activity.
Yeah,
So
Charles, that's a really good point. Pent up demand, right? We had a very slow 2025. We had a significant amount of extend and pretend, which quite frankly, I think was the right move back in 22, 23 when the Fed was raising rates very quickly. And to your point, people are cautious and they're being careful and selective, but there is a ton of capital out there. It has to get placed. And we're seeing again, that's what I call it, green shoots. We are definitely seeing a pickup in activity and expect to see more throughout 2026.
Well, how's sentiment? Anna, we have a poll question. Very interested to see what our group of attendees, esteemed group of attendees, thinks about commercial real estate. The poll question is, are you bullish, bearish, or neutral about commercial real estate? And if we get that pulled up.
All right, I just made it active. I'm not sure if it.
Well, while we're waiting for that, Tim, bullish, bearish, Brad, Charles? I don't want to ask the group too.
I clicked on as neutral. I think there's a lot of factors that are encouraging, and then there's a decent amount that say there's significant headwinds. John, you were talking to us this morning about housing stock that's being put on the market for rent in one particular area that is going to be competing obviously with multifamily. And so I think there's a lot at play that could argue either way. And clearly the respondents are seeing the world, I think, the same way that I do.
Yeah, so far, 52 responses, 2/3, 63% neutral, slightly more bullish to bearish sentiment, but the consensus is unsure. Brad, you're bearish, I'm sure.
Well, no, I'm probably more neutral actually, for a change, believe it or not. I don't know that there's anything that's making me bullish or bearish. It's just a lot of uncertainty, and it's the uncertainty that concerns me. That said, the multifamily issue, I think, and I'm in the Southeast, heavily invested in multifamily equity, and we are seeing the effects of overbuilding, oversupply, but demographically, we're going to be fine in the long run. So, in that product category, I feel pretty good. I think we'll talk about some of the other ones throughout this webinar this afternoon.
Yeah. Well, I mean, Charles, we were chatting on our pre-call yesterday. Sounds like one of your, I guess I'd say, complaints is how competitive is out there for commercial real estate dollars. Sounds like you're seeing, the deals you want to do, sometimes you're getting outbid, huh?
Yeah, I don't want to come across as whining, but there does seem to be quite a disconnect from the exuberance of, capital versus commercial real estate fundamentals, a disconnect. And granted, I really hate snapshot underwriting that the conditions that exist in this moment in time are going to exist forevermore. And I try to, look to the future with optimism, but it does seem like there is a rush to get money out the door. It seems like money that used to play uh, further out on the curve, doing, life companies in particular were known for doing longer term loans. The CMBS marketplace historically had been a 10-year marketplace, but everyone now is converging in 5-year money, 5-year terms or shorter. And so there's just an abundance of capital that is targeting the same duration. And I don't think we've seen that really before in the marketplace.
So are you seeing underwriting standards get looser?
Yeah, I would, I would answer that as yes. I think there's a lot of interest only underwriting that's occurring. And in general, I would say underwriting seems to be slipping as money has forgotten about the pain and suffering that they endured, a year or 2 years ago, and they're just back at it again.
Tim and Brad, what do you think?
Well, yeah, I'm totally with Charles on that. And I'm thinking through the cycle, right? And the cycle suggests, and by cycle I mean, again, the driver of my cash flow NOI is my tenants. And my tenants are only as good as their sales. And when you start showing me slides about consumer delinquency, I still think we have inflationary problems. I heard one of the panelists mention the T inflationary problem, which I hadn't heard of in a while, that being the transitory inflationary problem. I mean, either we got it or we don't got it. And I think we've still got it. So, how short-lived these spikes will be, we're getting whiplash over fuel prices and oil prices, but I need consumers to spend money. And to the extent that they're traveling to fill my hotels, they're buying groceries at our Publix anchored centers, and the office component is still fascinating. But in the industrial, where we've seen a lot of supply, that's last mile. I mean, there's 3 packages at my house a day, and I'm an empty nester. That's scary to me. But we're used to getting our packages, within a day, and they're still coming. Will they keep coming if the consumer starts tightening their belt? Will these restaurants stay as full as they are? Admittedly, I'm in the Tampa Bay area, which has seen a lot of new migration, but my platform is national, and I don't see it quite as robust everywhere. I mean, and enter Austin, Texas right now.
Yeah. Tim, underwriting standards, what do you think? Looser?
I have a slightly different view than Brad or Charles, and I'll tell you why. From a macro standpoint, and I said this earlier, whenever everyone is shouting that we've hit an AI bubble and the economy they're worried about a potential ugly word called stagflation. You've got the issues in the Middle East driving up oil prices, continuing inflation. I view that all as positive groundwork to surprise us to the upside. How's that?
You don't even know what that means, Tim, but it sounded great.
Sounds brilliant. Well, I mean, back to a basic, underwriting question. Insurance seems to be less of an issue. I mean, obviously still elevated. Property tax increases as well. Those were some key areas where we saw some big increases the last couple of years. Is that
wages
kind of leveled
salaries?
off? Is that insurance and property tax increases kind of leveled off?
Yes. And again, this goes back to my view of more bullish and not being as concerned about maybe some stretching in the underwriting. We've stabilized. Interest rates people have gotten used to, 6%, 8% money. If you can underwrite a deal, even a 5-year deal, Charles, and what is the likelihood that 3 to 5 years from now rates are going to be higher or lower?
Yeah.
And
I would
therefore,
say, I'd say, Tim, they're exactly going to be higher or lower in 5 years' time. I think you hit it on the head.
I think they're going to be lower. I think most people do as well. So underwriting a deal, if you know you've got a potential takeout because rates are going to be lower than they are today and have been fairly stabilized through 2025, that's why I think money is being put out. I think people are comfortable. And again, the tariffs go back to last April, right? There was a lot of issues in the marketplace a year ago. And again, obviously the Middle East is a little frightening. No one likes and wants war, but I think the potential long-term upside of that is huge. Can you imagine what an Iran that is user-friendly will do for oil for the rest of the world? It's huge.
And Tim, I think there's,
again,
I think
maybe I'm being Pollyannish, but I do believe that there's more upside opportunity through 2026 that will positively affect real estate than downside.
And Tim, I think that approach, that mentality, is a great one for private capital to be taking in the marketplace. But I'm not sure, regulated capital should go into commercial real estate lending in anticipation that interest rates will fall and that will, absolve any expense increases that a property is experiencing or lack of rent growth. And I think there's a real place for that optimism, and it's with private capital that's getting paid well to take that bet. And
right,
and regulated
Charles,
capital.
you're with a regulated financial institution. You make a very good point. Who's beating you out on those deals? It's private capital. Right.
Yeah, which is great because I can also play alongside private capital and I can, pick my risk tolerance in the structure by providing back leverage to them. Right. I think it's a great.
Let's say this private credit
relationship.
Let's say this private credit for a minute. I mean, it's a hot topic. Blackstone, Blue Owl have been facing redemptions in their private credit funds, which are obviously not commercial real estate only. There's other types of private credit loans. I mean, it's a hot topic. People are worried about it. Charles, are you pulling back your lending to private credit? Are you seeing stress amongst those clients of yours?
No, not at all. Not at all. I think commercial real estate's a little bit different. I think Blue Owl had an open-ended fund structure that doesn't comport well with the underlying credits. And in addition, look, they turned around and sold off a whole bunch of their loans at 98, 99 cents on the dollar. I think that speaks to the solid underwriting that occurred. It was mostly to, I believe, software companies, and the market was, in a panic, saying that AI was going to put all those software companies out of business. And, the headlines have moved along. And I think, Tim, you pointed out this morning that a lot of the private credit shops are seeing a rebound in their stock price as perhaps retail investors become more aware of the dynamics behind why there's a mismatch between an open-ended fund and the type of lending that they do. And, so we're all smarter for it. Are these things cautionary things to look out for, John? Yeah.
Point out that the majority of the private credit has been, or the issues have been on the corporate C&I side of the business. Commercial real estate, Blackstone as an example, they had probably one of the best quarters in new funds coming into their investments in a long time. So commercial real estate on the private credit side is doing well. And I think, Brad, you pointed out in our pre-discussion, commercial real estate tends to be a less risky asset because it's actually got, something backing the loan.
Yeah. I mean, I don't know of a single private credit lender that has pulled a line to a commercial real estate fund or pulled back the collateral. Not to say that couldn't happen, but that's when you know that there's real distress. when that activity. I mean, these redemptions. I mean, who knows why people are redeeming money? Maybe they want to invest in crypto. I mean, it doesn't necessarily mean the funds are performing poorly. No.
Well, I think some of the investors in the private credit, and I've been very disturbed with the idea of throwing the baby out with the bathwater in this private credit world, because we really are in commercial real estate a quarter at most of that. So I think, in the Wall Street headlines all suggest it's the C&I and corporates. So I think we on the CRE back leverage side are doing great, in the NDFI world.
Right.
John, one thing that I think we all have to be careful about is this dual pledging of collateral. So you had it with First Branch, you had it with MFS, you have it with some others. So, to the extent any regulated lender is providing back leverage, you have to have safeguards put in place to make sure that there's not malfeasance occurring with your partner.
Yeah.
Right.
Yeah, I mean, obviously, a loan on a fake invoice is a lot different than a loan on a property with the title policy. So the commercial real estate space is inherently less vulnerable to fraud than some of the other C&I spaces as well.
But don't tell that to Freddie Mac if you remember what happened a few years ago.
Yeah, they're not, as Tim points out, they're not completely immune just because they're CRE.
It's just a lot less.
Yeah.
It's not. It's more of a rarity.
You got to be vigilant, though. You got to be vigilant.
Yeah.
Always.
Well, speaking of doomsday scenarios, let's talk about AI. There was a paper that went viral a couple of weeks ago that outlined a scenario in June 2028. All these white collar jobs go away. People making $150,000 a year are now driving for Uber or Lyft, and now they're defaulting on their home loans because that DTI is irrelevant now because they're not making the income they're thinking. I mean, what do you all think of this AI doomsday scenario?
Look, John,
and how it might impact commercial real estate?
We all know the exact same thing happened when the internet came about, right? And I'm only being facetious. We were going to lose all sorts of jobs to these newfangled web-based companies, and that didn't happen. So I think I'm optimistic that the scenario you just depicted does not occur. But it's probably a little bit of a coin flip.
But at the end of the day, we will adapt around it because we will not have a choice. So, one day it's great and one day it's bad, this AI stuff. I'm certainly using it more and more and getting more comfortable with it. How it affects commercial real estate is TBD, but it's coming. So I think we gotta go with it.
Yeah, I've got a take that the next year or two will not have a significant impact in terms of the job market. Although you saw obviously a horrible job market report that came out last week, 92,000 jobs were lost. Although a lot of those actually were in healthcare, which is really interesting. There's a sub story going on that side of the world where they were hiring throughout 2025, and actually one of the big pieces of that 92,000 job loss came from healthcare. My view of AI is, as Brad and Charles pointed out, we have an ability to adapt. So the types of jobs that are going to become available are people who actually understand AI, have a working knowledge of AI, and can be project managers using AI effectively. You need to understand the technology. You need to be able to write the prompts. You need to be able to give it context for it to be able to perform the way it does. And then you need to be able to have the knowledge to implement it and to train people to use it. So those are the people who are going to find a lot of jobs. The people who are or have been or are doing repeatable every day, same thing, day in, day out, they're scared, and rightfully so, which is why a lot of young analysts coming out with a 4-year college degree, if they don't have some good AI experience, I think they're going to be sweating. And I see it. I mean, I get tons of resumes from kids coming out of college, and I give them the same advice. learn the technology. That's part of the adaptation that you referred to, Brad. Adapt to the technology, use it to become more efficient. I also will tell you that the buzzword with CEOs now, especially in public companies, is the labor margin, right? The labor cost margin, meaning how much more productivity can you generate with the same group of people? And that is very different from how you might have looked at it just in years past, where you were looking at revenues per employee, or cost per employee. That's changing.
I read a tweet that I thought was really interesting regarding higher education. A computer science professor at a mid-tier university sent their internal placement data. These are jobs before graduation. In fall of 2023, 89% of their graduates had jobs by graduation. It's dropped every single quarter. This semester, they're at 19%. So, you do have a segment of people that got computer science degrees, and that was always a very safe job. And all of a sudden, where are the jobs? So, it's certainly hitting higher education. And, one wonders how a lot of these mid-tier and lower-tier schools are going to survive, within a world in which you just don't need that many entry-level workers.
Well, if you go back 15 years, John, when you had a huge uptick in the early 2000s through 2010 of people wanting to go to university, and you had a big growth spurt in the number of students actually enrolled in higher education, that trend has reversed itself. And to your point, this is just adding fuel to that fire. There's going to be a lot of smaller colleges and universities that are basically going to shut their doors.
Yeah.
But that trend had begun already. And here's the irony. And again, my daughters live in Norway, and having a blue-collar professional job in Norway is a major career path for many people, very well respected. And guess what? The biggest issue we have in the automotive industry, in the AI development industry, we don't have enough mechanics. We don't have enough electricians. We don't have enough what I call professional blue collar, which needs to be filled. And I think what you're going to see happen is a lot of these kids who are getting out of high school now, or maybe even a year or two in college, are going to start going to trade schools. And I think it's already happening. So again, going back to our ability to adapt, I think you're going to see some seminal shifts, both in the higher education, both in the job availability and who can fill those jobs. Right now, we can't fill those jobs. There's no one out there.
Yeah.
John,
Ford Motors couldn't hire mechanics.
Yeah. Go ahead, Charles.
I do a lot of, lending on student housing. Do you think there's any cautionary flares in this conversation that would make someone who is, a sizable lender in student housing reconsider that space because people are going to move away from the big universities towards trade schools?
Well, it's going to take a long time.
I don't think it's the big universities, Charles. I think the top 50 will do just fine. I think it's that next tier. I don't want to pick on schools here, but the schools that are relatively easy to get in and are expensive are going to have a tough time. Now, obviously, they can reposition themselves to be more trade-oriented, but the community colleges are far better set up to shift to a more professional blue-collar workforce than, these larger mid-tier schools are.
Right. I just think we have too many schools. And they're too expensive.
You're absolutely right. No, I think that's self-evident.
So, John, stay away from any school with a big computer science, department.
I'm sure the major universities with 20,000 plus students are going to be just fine.
Charles, send me that deal and I'll have Claude do the underwriting for you. It'll be back to you in 10 minutes.
Let's talk about this. I mean, I think with AI, I was meeting with a family friend who owns 50, 60 Class B, Class C office buildings in New York City last week. And his occupancy is well into the 90s. But he's very worried about AI and what that will do. I mean, it seems obvious intuitively that AI threatens office. But it's probably very good for leisure, right? I mean, if we're working 3-hour work weeks, then the luxury hotel will do very well. The lifestyle center will do very well. Thoughts on how AI might
John,
help?
John, I love the future you're depicting. I can work three days and I could afford to stay in a luxury hotel. I'm not sure
Yeah.
those go together.
I like that.
Brad, thoughts on that?
That's a lot for me to process and how that kind of disruption. I'm having a hard time with some of the ADRs in these hospitality assets now. So to think that there's more demand for them, sending those prices up is hard because we have more free time. Maybe get more deals done instead, John. And instead of, maybe I'm not the best one to ask about leisure time, but I'm sure there will be implications.
Brad is a splendid tennis player, I hear.
Yes, that's right. I'll play a lot more tennis, except that the climate change is making it harder in Florida in the summer.
Yeah. Do you think there's a data center bubble, guys? I mean, I'm not. This is not my expertise. It's one of the few property areas that I've never really looked at portfolios on. But my understanding is a lot of these are in remote areas and they're highly specialized collateral. Are we building too many of these things?
Yeah, to me, it's technology meets power, and it doesn't seem like it's real estate. So I've stayed away from it.
Yeah, it's that's an interesting asset because it also doesn't have any alternate use once it's done. And to your point, the power needs are huge. So the real question is, if you're going to build something like that, who's going to feed it the power to be able to perform well?
And so Tim, you brought up something interesting yesterday about how much your own utility bill has increased because of your proximity to data centers. So maybe there is a broader real estate implication for multifamily, for industrial, for just other power consumers that are located in proximity to data centers and what it means for their expenses.
Yeah, so to answer John's initial question, I do not think there's an AI bubble, and I think there's going to be enough public pushback because of the issue with energy availability and cost of energy to the public, that people are starting to push back. I don't want that in my backyard. I happen to live in Northern Virginia outside of Washington, D.C., which is a hotbed. It's one of the top locations for data centers, and there's cranes all over the place. And I saw my personal electric bill spike up this winter. We obviously had a very cold winter, but it's not representative. It's actually the increase in power needs used by all these new data centers that are popping up and have popped up over the last 2 or 3 years.
Well, the other side of that, Tim, for me, is I've lent on a new small bay construction deal up in Richmond because of the proliferation of data centers up there and the ancillary need for businesses. So it's interesting, and maybe I made a mistake. I mean, but I think of the data centers in Northern Virginia as already being well established, and the DC industrial market has gotten so frothy that people are looking for lower cost alternatives. That said, absent all that, I am seeing a huge NIMBY move against it just relatively recently. And I know 6 states have already proposed moratoriums on new data center construction. We do not have one in Florida. And there was featured prominently in the Sunday paper, the one community that probably needs some economic development will not have it up there. I would be shocked if it happens, which is proposed as the first one in Florida. The residents don't want it.
Well, Brad, could you elaborate? We're going to have to solve for the power requirement. Obviously, nuclear is probably going to be part of the answer. Look at what Microsoft is doing with 3 Mile Island. And I think, Charles, you were the one who, or was it Charles or Brad yesterday in our pre-call, you were laughing about putting, Musk putting data centers out in the space. but we're going to have to solve for that. There is not enough energy capacity right now in the United States to be able to feed all these data centers and, more importantly, all this AI development. I mean, the one thing I heard is 5 years from now, look, AI has the ability to self-teach, okay? It's going to continue to improve and get better. You're now talking 3 to 5 years from now, the potential for super intelligence. And guess what? And by the way, definition of super intelligence is smarter than even Charles or Brad put together. And it is, but the power needs for that are huge. So we have to solve for that.
Brad, you made a comment about these data centers driving ancillary demand for small bay industrial. Is this just, for workers and contractors that are building these power centers?
Not so much as building, but supplying to them somehow, supplying to them in some ancillary fashion. And,
so the actual physical material.
Yeah, exactly. Yeah, exactly. But it's funny. I mean, in the report that they're talking about in Florida, people are concerned about diesel generators in these facilities and how that's going to affect their lung. They're worried about noise pollution, with fans that cool them. I mean, there's a lot of unknowns, I'm afraid, with this data center stuff.
Yeah. Let's switch over to multifamily. There's an article in the Wall Street Journal 2 weeks ago entitled "Austin Rent is About to Get Expensive Again." Austin is really exhibit A for distress in multifamily. You've seen 15-16% declines in rents. And this article seems to suggest it's starting to bottom out. What do you all think of that? Tim, is there a bottom in multifamily in places like Austin yet, or are we not there yet?
Yeah, no, I think we are. Again, I can't remember if it was Brad or Charles. You talked about the shadow, or was it you, John? You mentioned the shadow inventory of single family homes where people can't sell.
Anna, bring up that tweet, Anna, while we're doing that.
Yeah, that was an interesting chart. But my view of that is that is such a small percentage of the huge single family market in the United States. I think the numbers of single family, and again, 1 to 4 true single family homes in the United States is pushing 145 million. Those are huge numbers. So even if you have a handful of people that can't sell because they can't get their price and therefore they're going to rent, I don't think it'll make much of a dent. No different than institutional investors who are building for rent. That does not concern me. The bigger issue is demographics, right? And look, Mobile Oil just announced today that they're moving from New Jersey to Texas. As long as those southern states continue to grow population-wise, I think you're going to see, with a lack of new construction in multifamily, you're going to see certainly a pickup over the course of 26 and into 27. And I think, with a government, I think it's 88 billion for both Fannie and Freddie on the lending side. There's going to be plenty of capital out there to support trading of multifamily and continued investment in that asset class.
Brad, we did a webinar probably a year and a half ago, and we talked about this property right in your backyard in Tampa. Do you remember that project?
The one that traded for $28 million lower than when it was last sold?
Oh,
well, let me give you a better one right now. I mean, if I want to open the kimono, you're showing Cape Coral, Florida, where in 2022, we broke ground on a multifamily project that had its ribbon cutting 30 days ago, and it's not going well. So and it's a beautiful project, beautiful new project. And that market is just oversupplied of residential housing, whether it's single or multifamily, we've got a problem. And the good news is, coming from negative Sulzer, Tim's right. I mean, if we study the demographic flow, we will absorb these things, but will the debt holder and the equity holder stay in the game for the next 30 months while we hit stabilization?
Yeah, the thing I'd point out on the demographics, though, Brad, is our population is now aging and household formation is basically flat with deaths. Legal immigration is obviously way down, and you are not seeing the same growth in states like Florida and Texas. Florida was doing 100,000 new residents for years. They did 20,000 last year. So
yeah, there's actually a reversal for Florida, I think, because it's gotten so expensive and crowded.
Yeah.
All right. So someone on the call can find out who's got my debt and buy it at cents on the dollar, and we can work a side deal.
Yeah, you could take that chart down. I appreciate it.
So, John, a week or so ago, I listened to some commentary that was talking about how rents have quite a ways to run, and it was predicated on the notion that wage growth exceeds inflation. And then over the weekend, I was listening to a Moody's podcast, and they were talking about how wage growth is, I think it was Moody's, maybe it was Trepp, was decelerating and inflation is accelerating. So that wonderful little gap that indicates that we should have the ability to pay higher rents seems like it's going away and going away fairly quickly. And there's just multiple markets where we've seen significant declines in rents over the last 5 years. It's not just Austin, Phoenix, San Antonio, Jacksonville, Denver, Charlotte, and Pittsburgh, Sacramento, and LA, all with 10% declines in rent over the last 5 year in Class A, product. Those are pretty frightening numbers.
Yeah. But meanwhile, I think Cleveland had the highest multifamily rental growth in the past year. Chicago's doing quite well. So New York City is seeing some real rent growth. So I think multifamily it's very much the distress seems to be in the Southeast, but the older parts of the country are doing just fine.
Yeah.
John, I really appreciate the comment about Cleveland. Just this morning, we were reviewing a multifamily transaction in Cleveland that we decided to put an aggressive quote on. So, what a relief.
It's a good loan.
Good luck.
Make it more aggressive, Charles, and it's yours.
Yeah. Right. Well, let's talk about how we talk about bottoms office. On the negative side, the return to office figures from Castle are still pretty much stuck in the mid 50s. They are getting better, but they're still relatively flat. But a study came out last month that said it is like 6 or 7 times harder to get a job if you're remote only. So, office bottoming out, and is the return to office, the remote work a pipe dream that doesn't apply in this competitive job market anymore?
Yeah, I think my personal view, and just based on our special servicing portfolio, office has bottomed out, although we do anticipate 26 and 27 to still be very busy in terms of defaulted office loans, primarily because people who did the extend and pretend 22, 23, 24, those pipelines have run their course. Going back again to a comment I made earlier about stabilization in rates and what have you, most people don't think it's going to get any better. So if your extend and pretend didn't work, hey, it's time to pay the piper. Let's take the hit and let's move on. So we anticipate, especially with the maturity wall that's hitting, both in this year and 27, that we're going to see a lot of those loans finally come home to roost. And unfortunately, that some of them are going to mean they're going to have to default, whether we foreclose or do a workout or bring in new capital or what have you. The biggest issue that we always have with office, again, location, location, location. Downtown New York is obviously doing really well with good, solid Class A, B plus properties that are seeing huge rent increases, but it's the have and have not, right?
Yeah.
If you're not on the right side of the fence, or you don't have an ability to upgrade your building,
Yeah.
what's your option, right? Redevelop it into multifamily, but that's not easy to do outside of New York. So
Yeah, I mean, I'll give you a little anecdote on that. I took a walk over the weekend from the Flatiron Building to the Empire State Building to the Chrysler Building, and the Chrysler Building is a mess. Empire State Building, they've spent a ton of money on it. It's really a Class A building now. Its occupancy is way up. It's a great asset. The Chrysler Building, does have a complicated ground lease structure, but it's a mess. And, in one case, capital reinvested the asset. In another case, they haven't done that yet. So, I guess you just got to figure out which assets is it worth spending the money on.
So office may be the exception, but Tim, you've mentioned a few times this, extend and pretend. And I think there's very few lenders who have engaged in extend and pretend. I think most have engaged in give and get.
Yes, yeah, I agree.
And so that maturity wall may not be so bad because there's been pay downs. There's been
additional equity investment. You're right.
Exactly. Office, maybe not so much so, because it's hard to envision many office owners having capacity to give anything.
Yeah. Yeah, I mean, the office conversion thing seems to be very much a New York City phenomenon. I mean, have you seen many office conversions outside of New York City? I haven't seen much. Chicago, I think there's one building that's going to go forward in the South Quarter, and that's required a lot of money from the city and so on. Are you guys seeing conversions outside of New York City that are working?
I saw a plan in Phoenix, and I don't know if it came off the ground or not, but it seems to be more difficult because I think the reason New York has done so well is a combination of lighter regulatory requirements that the city reduced, as well as just rents in New York City support the cost to rehab a building or, turn over a building like that.
Yeah.
But my limited experience in the conversions is that the developer gets in there and realizes it's a much heavier lift than they had anticipated, just because of the nature of a retrofit and the MEP issues that they face with it. But I want to go back to Tim, dovetailing on Tim. I mean, I'm looking at more office deals. I can't even believe I'm saying this. I mean, I am looking at office deals and excited about them. And I think maybe to Tim's point, I mean, they're coming down to levels that are making sense again. And remember, office is hard to make sense of anyway because of the expense, the TI commissions in dealing with that, and then the perhaps questionable tenant, or credit of your tenants. So we are really having some fun with office right now, and treading carefully, but looking at a lot of office deals, highly selectively.
Yeah. Brad, you brought up the bankruptcy filings.
Yeah.
You mentioned that they're at their highest levels since 2013. What's going on there?
Well, it's funny, John. In preparation for today's call, I just looked that up this morning, and I was kind of surprised. And these were 11s specifically, which is what I have to deal with mostly. And I was surprised they were up that high. I don't know what it means, but I think that's another, perhaps headwind. We need to be. I need to delve back into it and figure out what's going on there. I
think a lot of that's a pileup from prior deals. I mean, we're marketing a loan that filed bankruptcy 2 Fridays ago, and everyone had given this borrower so much rope. My client had allowed $8 million in overdrafts, and every creditor just kept giving this borrower rope. So it's, when you say it is a new bankruptcy filing, but it's not a new issue. It's just there is, in some cases, a pileup of prior issues that haven't been resolved, right?
Well,
And Brad and John, do you find Chapter 11 to be an effective, option for distressed borrowers?
I mean,
well,
it can be. It can be.
but-
You know, in this particular case, it's going to potentially force the sale of the collateral. And when you have a borrower that people don't trust, doing it in bankruptcy allows the buyer to not assume the liability. So,
Right.
but the fees,
yes.
I was
I
on
mean,
a
that's the
call
trade-off.
with 50 attorneys, and the average billing rate's $1,000 probably, and the fees really eat into the estate.
Well,
Yeah, I
and
know.
John, why was there no solution outside of bankruptcy for this group? I mean, did the lender just force the hand and couldn't? I mean, someone had to be unreasonable there, it would
No,
seem.
no. Everyone was too lenient, and eventually there was a judgment from a vendor, and they were starting to repossess assets, and that is the ultimately would force the bankruptcy. No, my client never even foreclosed.
So
They
what
probably would have.
what does the borrower expect to get out of this, except 18 months and a lot of legal fees?
Yeah, the idea is that the borrower will get time to
Sell
either
the
find a
asset.
partner, sell the property, but the asset's severely bleeding. I mean, there's a lot of collateral in our position, but as this thing goes on, I saw the DIP loan, and like $16 million is wiped out in 13 weeks, and they're still not breaking even. So,
Jesus.
some cases, again, in this case, it was too little, too late. So I bet a lot of these bankruptcy filings could have happened years ago, but lenders were too lenient.
Well, Charles, we didn't answer your question, but it was a good one. I mean,
Well, the question I have for you, Brad, is it a canary in the coal mine?
hell yeah. I think we got a lot of those. There's a lot of birds in the coal mine. You know?
I am worried about the consumer. I mean, we talked about this, and I think, John, one of your questions was the K-shaped economy.
Yeah.
The consumer is this probably what I'm most worried about when I look out at the economic horizon in the United States, which drives all real estate, right?
Yeah.
And you mentioned that, Brad, in your outset. If the consumer gets really scrimped, and that horrible word stagflation, right? Low growth with high inflation. However, I will tell you, though, that with the advent of AI, we just came from a 2-day corporate meeting. Better, faster, cheaper. The deflationary effect of AI on production, on services, on everything else is significant. And so if the oil stabilizes, which I believe it will, where's the real inflationary pressure?
Yeah.
Well,
but the problem with the K-shaped economy, Tim, is it's essentially a concentrated bet. If half the country, if half consumer spending comes from the top 10%,
right,
you're going to have more of a shock to the system if, say, the stock market drops 20%, right? Because
you got it. And which is why you said that, high-end resort hotels are doing well. Because the people on the one side of the K are obviously flush with cash. Their stock portfolios have done very, very well over the last 2 or 3 years. They feel they can spend. You're right.
Yeah, no, I think we hit an inflection point when you're having conversations and you're hearing about beef tallow being put on your face to smooth out wrinkles. That's an inflection point that everyone should be concerned about.
Yeah. No
won't
comment
go
there.
We're not going to say which one of the four of us, uses beef tallow.
Let's talk about immigration. We got this immigration crackdown, and we're certainly seeing Class C multifamily. We sold a loan in Austin a few months ago, and the ICE raids knocked the occupancy down probably 10-15%. What else? I mean, are you seeing some distress coming from this immigration crackdown, or is that kind of faded away?
John, here's a bizarre one for you. I do a decent amount of mobile home park financing. There's usually RV components, and income is down. And I would say it's the Canadians, are big snow birders, and they're not coming with their RVs to Phoenix and Florida
Yeah.
as much as they were.
Yeah.
I mean, there was an article on CBS News that was fascinating to me because of our exposure in Southwest Florida, and they're mad, and they're dumping their real estate, which seems a little counterintuitive because that's a real emotional, to get rid of a nice home in Florida because you're mad at leadership seems a lot, but it has really deflated home prices in Southwest Florida. The Canadians in particular, who make a big part of our winter economy.
Yeah,
Yeah.
Brett, maybe that's helping the occupancy at some of the self-storage deals that I finance. Maybe they're angry
That
selling
could
their
be.
place, dumping their
There's
furniture into
always a
storage.
silver lining, Charles.
You think the
Always a
loss
silver
of the
lining.
hockey game will exacerbate it?
Yeah.
Yeah, that probably didn't help. Exactly.
There's been I've raised this issue a lot. I know Tim, you've called CMBS the subprime of commercial real estate lending, but you still have this big dichotomy between the credit quality of CMBS, which is elevated 7% delinquency, and the banks. While there was an uptick last quarter, bank multifamily delinquency is probably close to 1%, while CMBS is 4 or 4.5. Do you think we'll see more of a convergence between what we've seen in CMBS on the banks yet, or are banks just a lot better at lending on commercial real estate?
I think it's a combination of all the above, John. Number one, I've said this before, CMBS is not user-friendly. Remit clause, lack of ability of special servicers, which were a big one, and being able to be, financially nimble to restructure deals. You look at a balance sheet lender and private equity, insurance companies, banks, what have you. They just have an ability to help the borrower get the deal done or keep it alive in a much better way. And you combine that with the fact, and I know Lisa Pendergrass is going to kill me if she hears this because the head of CREFC. CMBS has become the lender in some cases of last resort, conduit lending, not SASB. Obviously, those are different, and it's a great source for the large loans, better quality real estate. But lower quality real estate, not a user-friendly structure, inability to be able to give the borrower a restructure that is user-friendly. You combine all those, John, and I don't see a convergence. I just don't see it happening.
Bob, you got anything for us?
John, I want to say, no, guys, that was great. John, I really appreciate what I enjoyed about your content is this was not clickbait fear driven. I mean, this is directly from people who are on the ground making deals. So John, hats off to you on that. This is real expert analysis, but I think your poll is wrong. This was a very very bullish conversation. And I think if you redid the poll, that 22% number is going to go up. Tim, I fact checked you, and I loved what you said about a stable Iran, what that's going to do, and no one's written about that. And I think that's a very astute observation because everyone's worried about the fear, but no one's written about, hey, what would happen if Trump pulls this off? So that's an amazing observation. So thank you for bringing that up, man.
Yeah. Well, 47 years of terrorism. Maybe we could do some less of that.
I mean, we all have to understand and understand what could go wrong, but no one's saying, hey, what if this works? Brad, I have a specific question for you from my SBA lenders in the hospitality space.
Yes.
2026. What should underwriters be looking for? What should lenders be looking for when looking at these $5 to $10 million hotel loans? Maybe that's the answer.
Right.
Hotel loans. Tell me, what's your advice for those guys?
Well, are you talking about limited service at that loan amount? I'm sorry.
Has to be limited service, that dollar.
Yeah, it has to be limited services. Yeah.
Yeah.
I mean, I still like, I like limited service probably the best. I mean,
Okay.
because that's what people need, I think. And that's the lower cost provider. I mean, but remember, limited services ADRs aren't so like they used to be. I mean, they're still pretty darn good now, depending upon the
Absolutely.
market. But
Yeah.
but as you know, Bob, it's all about the flag, I think. And the flag's going to be the driver of that occupancy ultimately.
And great answer. Great answer. John, expand real quick. Overall, for commercial real estate, small business owned commercial real estate, I assume the panel is positive on those type of $5 to $10 million transactions.
Yeah, I mean, I think that's a very liquid area.
Yeah.
We are potentially working on a portfolio where this particular bank makes loans less than $500,000 through an automated underwriting process. There's just a lot of liquidity in that size range. You know, when you go up in each market, when you say who can make $1 million commercial real estate loan in, say, Chicago, there's thousands of people. Then you go to 10 million, there's hundreds. Then you go to 30 million, there's 50, and so on. So that's a size range where virtually, the vast majority of banks can play in.
Very good. John, great content, great panel. Thanks.
Thanks, guys.
Thanks,
Appreciate
See
it.
you all.
Till next
Have a
Great
good
time.
one.
afternoon. See ya.
Bye-bye.